So take it away.
Awesome. Are we stopping the recording and starting a new one, and just continue it?
I'll continue it. Thomas will come.
Okay, perfect. So appreciate everybody being on. Good morning. I remember talking to my kids. We are a family of athletes, and my kids play track, football. My oldest son is in swimming. My daughter's in volleyball. She does track as well. They're constantly talking about wanting to be a pro in some level, in some way, shape, or form. And the one thing we have done, or I have told them, listen, this is not something you are required to do. You don't have to practice every day. You don't have to get up every day. You got to go to school. You got to clean your rooms, things of that nature. But as far as sports are concerned, it isn't a requirement in my household. But if you do want to be in a position where you can excel in sports, there are things that you need to do. And we wake up every morning at 5:30 and go work out with them. My kids are 12 and 9, right? And then, of course, I have a 2-year-old and my daughter as well. But my daughter is already in school. She leaves us, to school by 6 o'clock. But I'm going to start probably getting up earlier with her to start, to make sure she's also running and doing what she has to do. I tell them it isn't fun. That's not the exciting part of one day becoming a great athlete or playing at a high level. Guess what, guys? Neither is studying for class. Neither is studying to take the exam, right? Nobody said it was fun. Nobody said that it was exciting to go out and do these classes, especially when I started. I was already 30 years old. I was completely far away from studying. I hadn't picked up a book, prior to Primerica, and probably even during high school. I think I only read as much as I needed to, just to pass tests. I read my first full book when I got in Primerica. Literally, I swear to you, I've never read a whole book from cover to cover until I got here. So studying for me wasn't exciting, but it was a necessity, right? It was part of the game. And like Shonda, I'm sure she tells her agents too, and you guys do it as well. Once you pass the test, guess what? Forget everything you learned. We're going to teach you how it really works. Plain and simple. I would never forget this. I remember when I first started, I was taking the classes and studying the material to take the exam. And when I started studying, Shonda, there was one point, I don't remember what I told my man Dante, but I remember reading about whole life. And I came to Shaq and said, yo, man, I know we do term, but man, this whole life thing is really good, man. Have you read this stuff? And he looked at me and looked like he wanted to slap me. And, back then, Shaq was intense, right? And then he started breaking it down for me. I'm like, yo, that's crazy. How come they don't show this on the books? Guys, they can't. They basically can't, right? It's general information to go out and pass the exam. It's a lot different in real life, and that's what we're going to be covering today. So I'm really excited about that. And look, as I start this process, I think I can share, right? Let me see if I can bring up. There we go. Awesome. So I want to first cover some general understanding of the different types of policies that there are in the marketplace outside of term, right? Term is straightforward, guys. Term is coverage for a period of time, right? Whether it's a year, 5 years, 10 years, 15, 20, 25, 30, we have 35-year level terms. The coverage and the premium stay the same for that period of time. After it's over, then you can go out and you can get more coverage, right? But in most cases, it's going to cost you more money. Why? Because you're older, right? The moment you get older by even a year, the cost changes. And in some cases, you got to requalify health-wise. They got to reapprove you, right? Not in every case, not like our company where you automatically have guaranteed insurability. Not every situation, right? Relative to a cash value policy, this is what I tell clients. In a cash value policy, you're paying for two things. You're paying for the coverage plus a savings vehicle attached. Now, the benefits, as they say, are, number one, you get a guaranteed interest rates on your policy. Secondly, you can always borrow from it for purposes, emergencies, college education, retirement planning, anything that you can think of. Maybe you want to buy a car, maybe your first home, you can borrow from that account. And third, at any point, if you stop the policy, let's say 10 years from now, you no longer want it, whatever you have accumulated in cash value, you get to keep. It's yours. You can cancel the policy and whatever's in there is yours. And I tell a client, I say it just like that. And then I ask them, which one sounds more intriguing? And in almost every case, they say, man, the whole life. And I said, that's how it's sold. As a matter of fact, it's probably the worst financial product you can purchase. Let me show you why. I don't want you to believe me. Let me show you why. And that if they have a policy, because I've already determined that, that's how I go into it, right? It creates the curiosity. And for you guys, for just your concern and for the purposes of this training, as I explained this, number one, look, think about it. The guaranteed interest rate. Do we want guarantees as consumers? What do you guys think? Right? Most people would say yes, correct? Wrong. We do not. As a consumer, you never want a guarantee. Think about it. One thing that's a fact, every company needs to be profitable. How can they be profitable and guarantee you something at the same time? They only guarantee it because they're maximizing it on the other end, right? Banks guarantee certain interest rates because they make on average 15%. Insurance companies, the same thing. The average return, generally speaking, amongst whole life policies is 1.3%. That's the average guarantee rate of return. They're making 8 to 10 times more than that, right? That's why they're able to guarantee it. Secondly, right? Remember I said borrow. You can only borrow from your policy, which means it belongs to someone else. There's a creditor in place. So when you receive the money that you're taking out, it comes in a form of a loan. You have to pay it back. And third, right? If at the end of 10 years, they say to you, listen, I'm going to promise you have a guaranteed amount of money here of $14,000 that you'll get back. How awesome is that? Now, you guys have to understand the psychology of us as consumers is anytime we can get something back, we want it. And when you hear $14,000, for most people, that's a lot of money. Shoot, for me, it's a lot of money, right? So it sounds good, but what are you comparing it to? Because what if I told you you gave them $18,000 and you're only getting back 14? See, when you monetize it, that's when you can make a big impact, because it no longer becomes you selling it to them as much as you educating them. So first, you got to understand the different types of cash values. And ultimately, there are four. Now, generally speaking, a cash value policy is a category of insurance products that contain benefits, quote unquote. I should put that in quotes, right? In addition to the death benefit itself, such as dividends, interest rates, cash values available for loans, right? These are the quote unquote benefits that cash value policies give. And there's ultimately about four types, right? Within those, there's going to be a few, let's call them, I don't know how you call them, but a few differences within the whole life policy. For example, you can get a single premium paid whole life policy. You can get a paid option, a paid up policy for 20 years, so on and so forth. But essentially, they're whole life policies, right? So it's whole life, universal, variable, and IULs, which is more of the most recent type. So as you guys know, a whole life policy has a couple of things. Important is a coverage that's designed to have for your whole life. The moment you pass away is the moment they pay out. For a lot of people, that sounds attractive. In other words, I'm going to pay a premium, but I'm always going to get paid. Think about that logically. An insurance company cannot afford to do that. How can an insurance company be guaranteed to pay out a policy? How can that happen? And they'll go bankrupt unless they're not giving you the whole story. And that's where the high premiums come into play, and the loans and all that stuff, which we're going to catch up with later. Right, so the part of each premium payment goes into a cash value. The other part goes into a death benefit, and of course, you have other expenses that are associated with it, like commissions, administrative costs, so on and so forth. You also have no control in the whole life policy. There is no control of how much of the money you're paying, how much of the premium you're giving them is actually invested within the policy. That's the catch of the whole life. There is no determination of that. You pay a premium. You have the cost of insurance, and then you have the difference. We don't know how much of that difference actually goes into an investment vehicle within the policy, right? Then you have universal life policies, which are policies that the premium you're paying, the premiums are coverage, I'm sorry. in the policies, the premiums and the coverage are adjustable. So in other words, you can change how much of premium you're paying, and the coverage can also change on you, right? It has extra options compared to whole life, but it comes at a higher cost, at what's called surrender charges, typically the first 10 years, meaning that if you stop the policy within that time frame, some of the money you've accumulated, they're keeping. They're not giving it to you completely. And then it goes to nil by 10 years. In some cases, I've seen 15 and 20-year surrender charges, right? So that's the universal variable life policies. Is more of a hybrid. It's a combination of a permanent or a whole life policy with an investment vehicle attached. Now, the cash value is not guaranteed because it's invested in equity, so treasury bills, bonds, money market funds, things of that nature. The premiums are said to be guaranteed, but actually do fluctuate depending on the investment yields, right? Depending on how the investment goes, your premiums can change, but so can the death benefit, right? So imagine paying for something that is designed to be pure protection, right? You don't want something like a death benefit changing. In other words, I'm paying it for 10 years. I pass away. I was paying $150,000, but my family gets 80 grand. Because that can happen in your policy when it's a variable policy, right? Then you have something that is more recent. IULs, Index Universal Life. By the way, with this kind of life insurance policy, it gives agents the ability to sell it without without needing the investment licenses. That's the catch here. That's what it was designed to do, because it mirrors what's called an index investment, right? Like the S&P 500 or the Dow Jones, the Russell 2000, right? These are all index plans. So it's supposed to mirror that. It's not invested in it, it mirrors it. It's a lot different, right? So it combines insurance with investments, mirroring like the activity selected in index funds, right? So if the index goes up, you get a piece of the returns. If it goes down, you are protected. How good does that sound? Right? Except you only get a piece of the returns. You don't get the whole thing. What determines how much of it you get? That's the catch. You don't know. Right? You get none of the dividends in the index generates, right? A dividend in the investment world is sharing of the profits of a company. So when you are invested in mutual funds and the companies pay out dividends, that goes back into your investment and it grows. It gives you the opportunity to go further. When it comes to a life insurance policy, because it mirrors the index, is not invested in the index, there are no dividends that you're receiving from that. So if a company does well, even in a bad market, and they pay out dividends, you get none of it. Right? Don't forget, the dividend in life insurance is not like the dividend in investments. In life insurance is a deliberate overcharge of premium for potential return of it. Okay? So there is also a cap on how much you can gain. They don't give you all the returns that the policy does have. And plus, you pay the usual fees and commissions associated with these. And by the way, in IULs, they're very high commissions. Very high, that's something you need to understand. Now, let's kind of. I know I've given you a lot of information, and there are different variables, things you need to understand about these policies. If I was new like you guys, when we were growing up in the business, Dante can attest to this. Man, every policy we picked up, we literally read cover to cover. Not the most fun thing to read, especially when it's complicated. Right? Especially when it's complicated. But what? You wanted to become a pro, you got to put in the effort. You got to put in the time. Right? So I remember I was listening to something with Kobe, and he talks about the process of becoming a professional. One of the reasons he was great is because when he practiced harder than he would in an actual game. So when he got to the game, it became the norm. He was never intimidated by the last minute shot he had to take, because he took 1,000 of them in practice, right? You got to get to the point where you are able to quickly assess these policies that you come across, right? Like, Gabrielle did. I love her name, by the way. I think one of the best names in this whole hierarchy, Gabrielle May, right? And, she right away knew, she understood Fedley, how to cover it, how to read it, how to go onto the website and look through it and share it with the families that she's helping, right? Because she's a pro, because she practiced it before she got to them. She understood that. Imagine if she didn't put in that effort. Guess what? She probably wouldn't have the 4 sales. So while, yes, this is practice, this is learning, guys, take it seriously. This can cost you hundreds of thousands or make you hundreds of thousands, right? I remember right before we got off the announcements, Thomas put at the bottom, he was, I guess, putting the standard hierarchy channel, and he put, this can make you a ton of money on it. Guess what? It's true, man. You know how valuable that channel is if you're actually using it? Right? It's gold, man. So to the point where once you start picking up these policies, you're not overwhelmed with all the information. Shaq taught us when we were learning the business and we came across a policy, we were taught to say we were brand new and we didn't know how to really quickly look at it. We were taught to kind of open up the policy. I don't know if Dante learned this stuff really fast, man. He was just a genius when it came to this stuff. I don't know how, but you know why? Because he was actually smart. He never really was an athlete. So I'm an athlete, right? I'm not that smart. But the point is that I remember him saying that, we would look at the policy, open it up, and kind of go through the pages and be like, oh, wait a minute, hold on. And I would literally, and I'm thinking to myself, I don't know what the hell I'm reading. I have no clue, but I made it look like I did. And then I said, listen, I have to take this back to the office. We have an expert on hand. We're going to go through this policy. It's going to be great for Shondell and her training. So I'm really looking forward to coming back with something that makes a little bit more sense for you guys, be able to compare it. I'll make you a promise. We will never change anything you currently have unless it's an absolute impact in your situation. And that's how I got through it. Like, man, I don't know what I was looking at. I bring it to Dante and be like, yo, what the hell is this? Right? Can you explain it to me? Right? That's what we used to do. Man, guys, at some point, you can't do that. At some point, you got to be able to look at it, assess it, and quickly look at it. We're going to look at some examples today, right? So you do have to have a general understanding of the client's also current situation. This is more of from experience, meaning things like, has anything changed since they got the policy? How long ago was it? Who gave it to them, right? Who sold it in the first place? Are they a smoker now, right? Because I've gotten caught. I don't know if you guys have ever had this, where I'm killing the policy, I'm looking at it right away and doing a comparison in premium, and it's a lot cheaper without realizing they're now a smoker. That changes the whole game. And now you can look idiotic. Now that because they're a smoker, the cost of insurance has gone up and they're 10, 15 years older. Now you may not be able to be less money than what they were currently paying because their health changed. Or maybe they have I remember breaking down a policy years ago for this couple, and I'm again killing it. And then I found out later he had a heart attack a year ago. Not did I just waste time, I gave them hope, and they probably won't even get approved anymore. And I'm killing what they have. Right? Again, that's part of you becoming a pro. It's little things like that. Just ask, right? Throw it out there. Find out, right? What has changed? How long has it been, right? And here's some things to look at in the policy, and I'm going to bring them all up, and then we'll go through a few examples, right? You want to look at, obviously, who's the insured, confirm that. I've gotten many times where people tell me they're the insured and it's somebody else, right? It's their child or something like that. They meant they're the beneficiary, or somebody else is the beneficiary. So just confirm that simple stuff. Confirm their age, right? Understand that. When was the policy issued? A lot of times, and we all forget, especially if we got it a long time ago, it could be a lot older than it was, or maybe, maybe younger than it was, or what they've stated. Confirm how much coverage they have, and understand how to, a lot of times they feel they have millions of coverage, but what they have is 100,000 in whole life and 900,000 in an AD&D policy. Accidental death and dismemberment. It isn't equivalent. It's a big difference with AD&D relative to other types of life insurance. So understand those little things that will make a difference later. And of course, how much premium they're paying. And